Welcome to Online Trading Campus and welcome to our unique OTC Futures course. Let's continue with our Module 5 Expert. In Lesson 2, we will cover fundamentals for commodities. This lesson explains why fundamental data is essential to futures traders as well as what kind of economic activity are crucial in affecting price movements. I will show you how to read commodity reports and how they can be used to evaluate whether there are any physical supply and demand imbalances. Based on 2 case studies, you will learn how to connect the fundamental and technical dots to find high quality trading opportunities. Well, you may have heard of fundamental analysis as an equity or stocks trader. And that's real fundamental analysis based on a company's performance and outlook. You're looking at things like numbers, statistics, profit margins, quality of management, all kinds of different statistical ratios, financial ratios, and PE ratios. That's for equities. But for futures, specifically commodities, it's quite a bit different because there's no real PE ratio to look for. There's no quality of executive management of a company to look for. You're dealing with commodities here. So it's quite a bit of a different animal. We are still going to use a fundamental analysis to a point, but it's going to be focused more on specific commodities. And a lot of it's going to have to do with just supply and demand, really. Let's take a look at some more detailed examples of definitions here. Fundamentals, it's really the process that traders and investors would use to determine if they should buy or sell a commodity. Well, that's kind of vague. I mean, really, that could apply to technical analysis as well. So let's take it a step further. It's a process, yes, but we are going to start to incorporate in some macro and micro commodity data to determine the value of a particular commodity. Now we can certainly look at the charts and base our buy-sell decisions on what the charts are telling us. That would be more technical analysis. For what this is, we are going to look at specific commodity data like commodity reports that may be used. So on something like this, we are looking for specific commodity reports or commodity data, and it doesn't necessarily have to be just commodity data. It could be other factors as well, but bottom line, we are always going to focus on supply and demand, not just in a technical sense by looking on the charts, but for a commodity, we are looking for what's the supply and demand of that particular commodity. And I mean literally what is the supply and demand. Because when we talk about commodities, this is about as pure supply and demand market as you can get. For instance, there's a fixed amount of quantity of soybeans that are being harvested or planted. That's what we mean by supply and demand. Now, that's a major part of fundamental analysis, but it's not limited to other things like political factors, social factors, even economic factors. So there are other factors involved that we would want to consider when using our fundamental analysis, for example, political. So what would that mean? Well, what if a Congress or Parliament or whatever country you're living from, whatever governmental system they're using there, decided to tax a particular commodity, say sugar, and they decided to raise that tax? Do you think that would cause an issue between supply and demand? Or what about the volatility of sugar? Do you think that would increase? Well, potentially short term, but things will get smoothed out in the long run. So what if they did the opposite? What if that particular government agency said, you know what, we are not going to tax sugar, no tax? Well, that will certainly have an effect as well. What about social? What would social be? Well, if some major influential report came out that said, all sugar is really, really bad for you, in fact it's horrible, don't eat it, that could have an impact as well. Or what about economic factors? Maybe there's a recession or depression and people can't afford sugar prices, assuming they're high enough, so they're going to look to a different source to get their sweetener. Things like this happen all the time. If you look at, say, corn prices, if corn prices become higher and higher and higher, well, farmers aren't going to feed their animals corn. They're going to look for something else, maybe something soy-based instead, because if soy is cheaper, they're going to feed their animals soy instead of corn. But if soy is high in price, but corn is lower, well, then there you go. They're going to feed their animals corn instead of soy. They're going to be looking for what is the more affordable commodity or food that they can use. It all comes down to supply and demand, yes, but there are some other factors that we want to account for as well. All right? Let me take you back to Economics 101. You guys remember this chart? If you took economics, it may look familiar here. On the y-axis, on the left there, we have price. On the x-axis down below, we have quantity. Well, this represents demand, and demand, which is the green line here, demand will drop as prices move higher. For example, if you have a high price, in this case it's about $10 up there, you will have less demand quantity. People don't want to pay higher prices for things. Whereas if you have a low price, you get higher demand. More people are willing to buy at lower price. So this gets down to really the literal translation of supply and demand, and we are going to apply it to the commodity market. So when we look at supply and demand as a strategy, buy and demand, sell and supply, that's more applied to the charts. That's more the technical analysis side. Whereas this on the fundamental side, and it's perfect for commodities because really when you look at commodities, they fluctuate, the prices fluctuate based on supply and demand, based on quantity, based on price, things like that. Now let's flip this around, look at supply, which is the red line here. Supply will rise as price moves lower. So if you have a low price, the supply tends to be lower. The higher the price gets, supply tends to get higher or more supply here. So when we look at both of these together, our supply and demand curve here or analysis, right in the middle where the supply and demand intersects, that's what is referred to as equilibrium. If price of the commodity is above equilibrium, that would be a surplus of that particular commodity. And if it's below equilibrium, that would be a shortage of that particular commodity. Think of it this way. Let's stick with corn. If corn were in a shortage, how would that affect the price of that particular commodity? What if corn was in a surplus, meaning there's a lot and lots of it? How would you think that would affect that particular price of corn? So if there's a surplus, typically prices will drop. If there's a shortage of something, typically prices will rise. And there could be many factors that cause this. It could be maybe some extreme weather that cause either a shortage or potentially even a surplus, depending on what that factor is. So it could be a political issue. It could also just be the natural rhythm of the seasonality of that particular commodity. We'll look at that in just a few minutes here. Let's keep moving here. The fundamental analyst can use specific commodity reports to determine actual supply and demand for any of these particular commodities. Soybeans, natural gas, crude oil, corn, pretty much every commodity out there has some kind of either government report or some kind of analyst report for that particular commodity. So how can this information actually help us traders find some trading opportunities? Well, that's really the important stuff, right? How do we make money? How do we find good trading opportunities? First of all, we want to understand there are some resources out there available to us, and we are going to go to these resources to identify what these reports are going to tell us of supply and demand. The first one would be the Chicago Board of Trade, and they really specialized in agricultural type commodities and what's referred to as softs. Chicago Mercantile Exchange specializes in meats, New York Mercantile Exchange, energies and metals, ICE, Intercontinental Exchange Futures in the US, they focus on agriculture and softs. And of course, we have more on the government side, the USDA, US Department of Agriculture, the Department of Energy, and many other financial websites out there. There are really hundreds and hundreds of different websites out there that you can get information and data from. But these are really the main ones. Go directly to the exchange that you are trading on, or the government reports that's reporting on the commodity that you're looking for. Alright, let's get specific now. Now that we have some resources that we can go to and use, let's take a soybean example. Soybeans. One question we would want to ask ourselves is, what is the current amount of soybeans in the ground? Now, they don't actually have an official one person go around and count all soybeans in the ground. It's not quite like that. But they do know how many soybeans were planted, what they can expect a harvest from, how much are currently still in the ground. So they have some pretty good estimates of how many soybeans are actually in the ground without going and counting every single one of them. Another thing, how much soybeans is still unsold and left over from the last harvest. In other words, how much supply is there? How many have been harvested? That would be the demand part of it. And then what would be a forecast? And of course, there are many other factors. What about technology, for instance? As technology improves, these commodities that they are harvesting, the yield that they produce get better and better and better. Political events, work strikes could cause a spike in volatility. Weather extremes, crop disease is always a big issue that people are looking out for. Social issues, for example, GMO versus non-GMO, organic versus non-organic, all kinds of social issues that could go along with affecting supply and demand. Alright, now let's take a look at the actual CMEgroup.com website. When we go there, we are going to pull up these soybeans reports. Now, this is what's going to tell us specifically what this report is telling us. And it's going to give us a supply and demand or bullish and bearish outlook based on fundamentals. Now again, we haven't even looked at the chart yet. Keep that in mind. We are just talking about the fundamentals first, and then we'll go to the chart and look for specific trading opportunities depending on what the fundamentals will tell us, if it's bullish or if it's bearish. In this example, when we look at soybeans report, we have periodic reports that we can look at. For example, the USDA monthly supply and demand. That would be good to know. There are other things like supply charts. So if you want to know what the supply is for soybeans, you have a whole list of charts you can look at there. Demand charts, same thing there. These are reports that are more specific to demand. And then we have other reports for corn, wheat, and there's many other examples in this particular website here. Alright, now let's get a little bit more specific. Once we click on that soybean USDA supply and demand review, this one happens to be on June 9th, 2017, specifically for soybeans. And this is just what the first page looks like here. What I'm going to do is going to kind of focus in on this part right here that's highlighted in the green rectangle. Here's more of a bigger zoomed out view for you. So take a look at the green portion that's highlighted. It says soybeans, the June USDA, that's again the USD Department of Agriculture Supply Demand Report for soybeans, had 2016-2017 US ending stocks at 450 billion bushels versus the average estimate of 434 million bushels and compared to 435 million bushels in May, and so on and so on. Now, if we look further down, we see that the price outlook after that supply and demand summary was considered slightly bearish. There's a keyword for fundamental analysts: bearish against price outlook. Guys, this is a big deal here. When there are expectations of what soybeans should be, the crop yields and stuff like that, if it's more than what is expected expected, or if it's less than what is expected, that could have a big effect on the market. In this case, they're saying it's bearish against trade expectations. Well, let's find out why. Old crop ending stocks came in at 450 million bushels versus the average estimate of 434 million bushels and from 435 million the last month. And it has a price outlook at the bottom, but here's the key thing, they're talking about soybeans being bearish. Well, why is that? Well, it's saying it came in at 450 million, but they were expecting only 434. So because it came in more than what was expected, that means there's more crop or more soybeans in this case. So there's more supply. What does that mean? Well, typically when there's more supply, prices start to fall. There becomes less demand ultimately, and price starts heading lower, becomes bearish because there is a surplus there. There was more than what was expected. So alright, here's another way of looking at this, and this is the other part of the supply and demand review. Take a look at this area that's highlighted in green. It says area million acres. Well, in 2015 to 2016, we can see that 82.7 million acres were planted and 81.7 million was actually harvested. So less was harvested than was actually planted. Well, that's not all that uncommon for any kind of crop to lose some of its yield, really, because crop disease, weather, things like that could affect and not get the full amount that was planted. Just like if you grow tomatoes in your garden at home, you're expecting, let's say, 10 tomatoes per vine or per plant, but you only got 8. Why did those other 2 not yield? Well, because you got birds and birds got the other 2. So you're not always going to get everything that you wanted. And you can see it, the whole theme is like that for the rest of the other years as well. But look at 2016 to 2017, planted 83.4 million, harvested, this point was 82.7. Again, less than what was expected, but more harvested compared to the last year. And again, we have the same theme for June 17 to 18. We have more harvested compared to last year June. That is again creating a surplus here. So we've had a couple of different versions of this report say that there is a surplus, that they are bearish. Why? Because there is more soybeans than expected. That's where the fundamental analysis comes into play. And that would lead us to say that we are bearish on soybeans. But wait, there's of course more. We got to look at the chart, and here's a chart, and as you can see on the date of the report release, price of soybeans is in daily supply. We can also see that the trend is down since we make lower highs and lower lows. Now, you could have shorted the daily zone or refined it since there is a high quality supply zone on the 480-minute chart that hit a couple of days later, and then we see price dropping like a stone, and the rest is history. So what's the teaching point here? We combined fundamental analysis with our supply and demand analysis, and both gave us a clear sell signal. That's confluence. We increased our odds of success tremendously. And why is price now dropping from a fundamental standpoint? Again, because of that surplus, there are more soybeans out there in the market, so there are less and less people that want them, and they're willing to pay a lower price to get them. And so when you look at this chart right around mid of June, it really starts to go down, almost straight down in fact. Lots and lots of selling power and selling pressure. Alright, so that's soybeans. Let's take another look here at a different example. Let's take a look at natural gas. This is a chart that shows where natural gas is being extracted most prevalently. So you can see New Mexico, Oklahoma, Texas, Louisiana, the Gulf of Mexico. Those are really the primary ones. And of course we have Wyoming up there as well, a big natural gas production state as well. The ones in the lighter blue and even the lightest blue, they are still producing some natural gas, just not quite as much. So mostly those southern states there in the south central Texas and New Mexico and Louisiana, so on, and Wyoming. Alright, now let's also take a look at natural gas production. We can see natural gas production since 2007 has a nice steady rise, so there's more and more production going on here. Well, that's a real big picture look at what's happened in natural gas production for several years. But let's start to get a little bit more specific and more focused on what we can do now about natural gas. First, we would look at something like this, the natural gas inventory reports. Now, there are many different financial websites that would provide this information. This just happens to be one right here at Forex Factory, and that's fine. There are many different ones that we can use, but this report comes from the Energy Information Administration. What does it measure? It measures the change in the number of cubic feet of natural gas that has been held in underground storage during past week. So in other words, it's saying how much gas is being held in storage. And this is a weekly report that comes out 5 days after the weekend. So in other words, Thursday. Unless there's a holiday, you might see something change up there, but for most weeks it'll be on a Thursday, alright? This is also called natural gas inventory or the inventory report. You may hear that one as well. Let's take a look at what this looks like on a chart. We go back to 2014 really, and we are starting to see some real cycles that happen here in natural gas. Look at the inventory lows. Well, the inventory lows happen year after year after year in December, January. In that range of December, January, the inventories have low period that they go through. Well, this is interesting because natural gas is very much what we call seasonal or has the seasonal fluctuations. More on that in the next lesson on seasonality, but you can see it right here. Year after year, it's like it's the same cycle. The inventories lows are set in December and January. But now look at this. The inventory highs or the peaks are in June or October. So really the highs have kind of this little double peak in June and October, and part of that has to do with natural gas being used as both on the commercial side but also on the residential side. In the summer times, people running their air conditioning units and it's fueled by natural gas, but in the winter time people got to stay warm too, so they use natural gas for that. But it's being used a few different ways. So you see these double peaks here in June and October. Now here is the real interesting part. Take that fundamental data that you see right there, and now let's go start looking at some charts. The next chart I want to show you, it is really quite fascinating. So just remember December, June inventory lows, and the peaks here are June, October. Now take a look at this chart here. This is what's called a seasonality chart or seasonal chart. What this is basically explaining here is what natural gas is doing year over year over year over year, but what is it doing each month? So this particular chart is going all the way back to 1990 to 2015. That window or that time period, it's collecting all the data of natural gas and averaging it each month. Take a look here. The lows are set in December, January, February. So if you go back all the way to 1990 to 2015, all of those years, the average of those years, the lows were in basically January, give or take 1 month. So it could be December one year and January the next year, or even February, but right about January, give or take 1 month. Those are the lows that are set in. Then take a look at the peak here in June and another peak here in October. Remember what the previous example was, inventory the lows, and down there were in December, January, when we see the seasonal lows here for natural gas. And those double peaks of inventory that you saw were in June and October. Well, that lines up perfectly with this chart. So how do we find a trading opportunity on this? Well, guess what? Right about January to March, really, you need to be prepared for a buying opportunity and looking for buying opportunity here in natural gas, because right here is your window of opportunity from about January, maybe even December. Start looking right around that area for buying opportunity using your supply and demand strategy and look at that run up that you get. Now, not every year is going to be like that, but most years that is what actually happens, where you have the really strong move from January all the way up until mid to late April, and then it's kind of starts going down from there. But this is what we call seasonal influences. We combine this with the fundamental aspect and bingo. Then we identify a great buying opportunity using our supply and demand strategy, in this case a demand zone that would get us in a trade. Look how identical both charts look like. On the left, 25-year seasonality chart, and on the right, the actual chart where we could have potentially taken the trade based on seasonality and our supply and demand analysis. And we're able to not only buy because of this demand zone using our supply and demand strategy, but we are bullish on the fundamentals. And of course, we are also incorporating a little bit of fundamental or seasonality aspect of the fundamentals to this as well. So there's quite a bit of things that we can use when we are looking at trading these commodities. Alright, let's summarize what we covered here. What are fundamentals for commodities? And number two, how can fundamentals help us find trading opportunities? Remember, we can focus on the fundamentals and get our data from that and look, are we bullish? Or are we going to be bearish on this particular scenario using the fundamental information? And that could be data from the particular government agency, data from the CME group, and that kind of thing. We get that data, analyze that data, identify, are we bullish, are we bearish, check to see if there's any seasonal influences, which is also a part of fundamental analysis as well regarding these commodities, and then match it up with our charts and supply and demand strategy. So that's it for this lesson. In the next lesson, we will fully focus on the seasonality factor, since this is an important tool for us on top of our supply and demand strategy. So stay tuned for the next lesson.